Hello, welcome to AFM 451. The objective of this video is to show that audit strategy is not selected arbitrarily, but is derived logically from risk assessment, moving from understanding the nature of the entity to determining where and how audit effort is applied. Let's get started. We start with the risk assessment procedures. These are not box checking exercises. Inquiries, analytics, observation, and inspection are used to build a working understanding of the auditee's business and its environment. The auditor is trying to understand how the business actually operates, how it's making money, where it is vulnerable, and where management judgment is most consequential. This understanding is the foundation of everything that follows. This understanding is also structured around several dimensions. We look at the nature of the entity, its operations, ownership, financing, complexity, etc. We consider the industry, regulatory, and external or macro factors that shape incentives and constraints. We examine the auditee client's objectives, strategies, business risks, because aggressive strategies can often result into financial reporting pressure. We assess management's performance measuring and monitoring practices, which signals what management cares about and how results are evaluated. And finally, we consider both management and governance, because the tone at the top and oversight quality directly affect the reliability of financial reporting. From this foundation, we then move on to identifying the business risks that may result in material misstatements in the financial statement results. This is the critical translation step. Not every business risk is an audit risk, but many business risks create incentives or conditions that increase the likelihood of misstatement. For example, a strategy focused on rapid revenue growth combined with equity-based compensation can create pressure that may manifest as aggressive revenue recognition or even biased estimates. Now, once these risks are identified, they must be assessed and prioritized. And as we've seen in one of the previous videos, auditors evaluate both the likelihood and magnitude in considering whether risks are pervasive and/or account-specific. This is where professional judgment and skepticism matter the most. High-risk areas are not simply noted, they are elevated, and they explicitly drive the auditor's planning decisions. And of course, the final step then is about mapping these risks in order to determine the audit implications. The identified risks are linked to specific financial statement accounts, relevant assertions, and the resulting impact on the audit work is then determined. This then, in turn, helps determine the nature of procedures, their timing, and their extent. A high-risk estimate may require special involvement, year-end substantive testing, and of course, expanded sample size. A pervasive risk may require changes to the staffing model, increased unpredictability in our audit approach, and even heightened scrutiny across multiple areas. Consider a regulated financial institution experiencing declining capital ratios. The business risk is regulatory pressure and capital adequacy concerns. The audit risk is the biased valuation of financial instruments, the aggressive calculation of classification of decisions. The audit response follows directly. Focus on valuation assertions, use independent pricing sources, involve senior audit team members more, and of course, perform procedures as close as possible to the year end. In conclusion, an audit strategy is derived from following the logical chain of risks, the affected accounts, the assertions, and of course the audit responses. This process ensures that the effort is concentrated where it matters the most, providing a robust basis for forming an audit opinion. This strategic focus on risk influences every decision, driving the nature, timing, and the extent of the audit work. Thanks for following along. Take care, stay safe, and bye for now.